Have you ever been frustrated and pissed off and felt like the whole market is moving precisely to make a fool out of you? I know I have. And in this video, Lance Breitstein, the number one P&L prop trader in back-to-back years, shows you how to fix the one error that can make all the difference in the world to your trading. This one tweak can be the difference between success and failure. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading account.
Hi, I'm Lance Breitstein, and you can follow me on Twitter at @TheOneLanceB. In this video, I'm going to discuss how you can turn losses into big profits with this one really super crucial mean reversion concept. It really comes down to trading psychology. So let me tell you, there is no hope in sight for me. Have you ever been there where you're really struggling month after month after month, and it seems like every single thing you do, the whole market is moving precisely to make a fool out of you? Every trade that you do take doesn't work. Then you finally cut yourself off and the bounce you were looking for happens. Does that sound familiar? It definitely does to me because I was there for so many months doing the same psychological mistakes again and again. So many days I would sit there and marvel at how my boss and I had such drastically different results despite us trading pretty much the same tickers and going for the same types of moves. Then the concept finally clicked and it changed everything for me. A lot of times really small changes can have outsized impacts. In this video, I'm going to present one of the most important but counterintuitive concepts in mean reversion trading. The reality is, in markets, untrained human psychology results in the exact worst decisions you can make. I remember starting out how often I would be buying the top, then selling the wick lower. It's so common, we've all been there. But fixing these psychological errors of the untrained human psychology, and then more importantly, understanding the concept that I'm going to present to you can make all the difference in the world to your trading. This one tweak can be the difference between success and failure. It really was for me, and this is what helped my mean reversion trading really take off. The question I want to ask you is, do more legs make an opportunity better or worse? So in general, how do you deal with situations where you think the right side of the V is in, but then you get stopped out and it has another puke lower? Do you re-enter? That was a question asked of me on Twitter, and it's a really great one that's so important to dissect. Something's selling off, you go for what you think is a bounce, waiting after the turn, but then it makes a leg lower and really pukes. What do you do there? Do you stay out or do you jump back in? So we're going to have a process of how to judge whether these opportunities are getting better and worse, and therefore how you want to trade them. So I drew up this simple chart of really what's the mistake that every rookie always makes, and me included in this. I've seen this so many times while trading dozens of traders because it's just basic human psychology. Until you train yourself otherwise and understand this concept, it's just so common to do. I don't fault anyone for that. So in this sample chart, a stock makes a leg lower from 6 down to 5. You buy the turn, you have your stop at lows, and you take a loss. Okay, no problem. It makes another dollar leg lower from 5 to 4. You buy the turn, and now you take a loss once it fails again. At this point, you're really frustrated. You're thinking to yourself, oh man, am I just going to keep taking these losses? Am I going to hit my daily stop? Is this just a bad idea? And so what very frequently happens, it then makes one final leg lower. Oftentimes, this is where the real capitulation occurs. It increases in speed or volume, and then it turns. And what I would find myself always doing is because of those previous losses, I'd be unwilling to get back into that trade. What I recognized my boss doing is he would always be buying more there and getting a bigger position than he did on the previous attempts. And once we spoke about this, it finally started to click, and I did the math for myself, which I'm going to help walk you through this process. So really, it all comes down to this. In mean reversion, the more legs down in a straight line, all things held equal about those legs, the more probable a bounce becomes. I can't stress that enough, right? So let's just make up some numbers. If the first leg down has a 30% chance, the second leg might have a 40% chance, the third leg might have a 60% chance, and the fourth leg has an 80% chance. If they're all the same type of legs, that's super important to internalize. And what this really comes down to is almost like that pendulum is swinging so far over, right? The other thing to recognize is the more legs down in a straight line like this, the more the reward increases. I use a 50% base case retracement of the overall move. So in subsequent legs, that's getting bigger and bigger. So let me explain to you the psychology of why this works. And we're going to use something very simple like Apple, and we're just going to, really break this down in simple terms. Let's say Apple's trading at $100. Let's say the first leg down goes to $98. So a 2% discount, right? Assuming no fresh news or anything like that, you can buy Apple 2% cheaper than you did before. That might attract, some people. Not only are you getting more potential buyers, but you're also getting less potential sellers, right? Maybe people are willing to sell at 100, but at 98, some incremental less amount of people are willing to sell there. Now, just for the sake of a crazy example, let's assume it went all the way down to $50. The amount of people that are willing to buy Apple 50% lower on no change in fundamentals is enormous, right? Warren Buffett would be at the front of that list along with many others. And guess what? How many people are willing to sell Apple at $50? Certainly much less people or fewer people than they were willing to sell at 50. And you can take that to the extreme, right? Let's say Apple went from $100 to $1. The reward on that would be enormous, right? If that reverted back to the previous price, the unaffected price, your reward would be 99x your risk, right? That is incredible buying at $1. Everybody in their right mind would want to buy at $1, right? So I know that's an extremely crazy example, but working these extremes is what really builds us our framework, right? So for every leg lower, you get less people that are willing to sell at those prices. You get more people that are willing to buy. So that's why this concept works, right? I'm not making this stuff up. It's just purely based on supply-demand economics and psychology. So now one of the most important points to stress, though, is this assumes no fresh news. Mean reversions in stocks with fresh news is infinitely more complex and dangerous, right? A fundamental change in the stock due to news is different, right? If Apple says, their sales are down 99.9%, I don't want to buy that stock at 98 or $50, right? This is assuming all things held equal, and it's just the price action that's moving. So now let's dive into the expected values in that previous example I gave. And I beg you, when you do your reviews, you must look back and break down all the expected values and run the math. All the time in the SMB meetings, we do this, right? So many times traders have preconceived notions, but they haven't ran the math. And once they do, it really informs their opinion and often changes their mind. In that example I gave, let's assume 50% retracements are the base case and that the risk to lows each time is about 20 cents. So at point A in the example, when we've gone from $6 to $5 or so, let's say the reward is 50 cents and the risk is 20 cents. And we're just going to assign a probability of 40% chance it works, 60% chance it goes to lows. The expected value on that is 32 cents, right? Wonderful. And so a lot of people ask, why would you trade point A and point B instead of just trading point C? And so the reason why we're trading point A is because we perceive that it has positive expected value. Anytime there's positive expected value, theoretically, if you trade that trade enough, you're going to make money on it. So that's the reason why you're going to enter there. But when it doesn't work, as anything can, right? This is a probabilistic game. You get stopped out, no problem. So then it makes another leg lower to point B. And now the overall move is $2. As a 50% retracement, we're going to say the reward is $1. And again, our stop is 20 cents lower at those lows. But now, based on that concept of having less marginal sellers and more marginal buyers, the probability of this trade working is now going to be 60-40. When you run that math, your expected value just a little bit more than doubles and you get 68 cents. So that's really, really great. Now we're going to go to point C. And now the move is from $6 to $3. Based on that 50% retracement, $1.50, same risk. And again, what do we see here? I've upped the probabilities even more. Why? Because again, the people that are willing to sell at 6, there's way fewer that are willing to sell at 3 on a quick, multiple succession move of legs, like something like that. You count the expected value, you get $1.24. That is a huge difference. So really, the expected value reveals all. Like every single trade you do, whether you recognize it or not, it's 100% based on your perceived perception of like what is that expected value. If that expected value isn't positive, you never want to be involved. If it does, you probably do to some degree. So what we found is based on those very rough assumptions is that point B was 2x, the expected value of point A, and point C was 4x, the expected value of point A. So much like in poker, the higher expected value, the more we want to bet. It is so often that people don't recognize that concept. The higher expected value, more you want to bet in general, right? So how does a typical rookie bet? As we discussed, they might bet on point A, but then in point B, you've already taken a loss, you're licking your wounds. And so many people then in point B bet less, they lose again, despite the expected value being better. So then when it comes to point C, where it's the best opportunity yet, because of those two previous losses, they end up stepping back and not betting at all. But trust me, it's classic. I've been there and done it. We all have. But it's so important to recognize what's happening underneath the hood with the expected value. So this is how elite traders bet, right? Because it's positive expected value at point A, they might still buy and take their loss there. But they recognize that on that second leg, the expected value is getting better. So they might then buy more. And again, it's totally fine to take a loss. But when you make 3 legs in a row, you want to buy way more and win big. Same for 4 legs, 5 legs, and so on. So now it's so important to discuss the caveats. And again, I need to stress, this assumes no fresh news. Mean reversion in stocks with fresh news is infinitely more complex and dangerous, right? So what could make the next leg worse than the prior leg rather than better? So here's the way I like to think about it. If the new leg is slower velocity, or if it's smaller in ground covered, or there's no volume or price capitulation, or if it occurs after a ton of consolidation, those are some nuances and variables that might make me think, okay, maybe this expected value isn't getting much better in this second leg. What I really want when I see the first leg and then the second leg to point B is, in an ideal world, each subsequent leg is getting larger, faster, more panicky, and velocity is just so important. I want to see all that volume flush out. I want to see all the weak hands panicking. And what that does is when people panic and you get that flush out, you get all the people that were going to sell out, you get new hands in at a new average price, and based on that marginal willingness of the buyers and the sellers, like I discussed, you end up with this imbalance that then changes those probabilities. So also keep in mind though, this concept does work to the upside, but the upside moves are inherently more dangerous just due to no upper bound. What do I mean by that? Well, something that's going to the upside can technically go to infinity, whereas to the downside, you can only go to 0. So in a lot of plays that can come into play where the upside becomes more scary. The other thing with upside is you have to worry about short availability in stocks that are really, really going, especially the low floats. So does this concept apply? Yes, but I do urge caution, and you really need to be sure about how you're handicapping those trades. Here's a big misconception that kept on coming up. So many people would say betting like this is how you blow up. But I need to stress what this concept's really about. It's about recognizing that your expected value is increasing. That in no way does not mean blow up. So let's not conflate what I'm saying. All I'm saying is in pure mathematical terms, the higher the expected value, the more you want to bet. That is inarguable. That is just basic math, guys. So I'm simply making the point that the more legs down, the better the EV is getting. And in theory, your betting wants to reflect that. Most amateurs, due to psychology, do the opposite. Pros take advantage, and their sizing reflects this concept. So that does not mean forget all risk management and go out there and blow up. You always need to be using a daily loss limit, and you always need to stop. So what does that mean in practice? That might mean that in point A, you might need to size down on the early legs so that you have room to size up if the trade gets really, really juicy. So sizing and having a stop is how you control your risk. That's true in any situation, right? You can theoretically blow up in any trade if you're not sized properly. If you trade any trade 3 times, even if it's a breakout or whatever else, if you're not sizing, anything can take you out of the game, right? So risk management and proper size is not mutually exclusive from this. You need to always be following your rules, always be sizing appropriately, and always be trusting, that if things aren't working, you need to make sure you're handicapping and second guessing to make sure you're not missing anything, right? So this is really what that concept's about. This drove me absolutely insane. But on Twitter, so many people are saying, oh, this is just the Martingale system. For those that might not know, a Martingale betting system is where you take something like a coin flip and you just double your bet every single time. And the reason why this drove me out of my mind is this is not remotely the same. And People that thought that, they don't understand what a martingale betting system is, because that's where every bet, or in this case, subsequent legs or coin flips or whatever, has the same odds and expected value. The whole point of this video is making the concept that subsequent legs have better odds and better expected value, right? So that is exactly the opposite of a martingale betting system. So I can't deal with the armchair idiots trying to sound smart, but they don't know what they're talking about and just talk nonsense on Twitter. This is not the same. So what this really is this is one concept that can really change everything for your trading, right? Because what happens is risk management is always key, but in your betting, you need to recognize that the EV is constantly changing, right? And in so many subsequent legs, as things get better, your bet sizing needs to reflect that. And so often our human psychology does the opposite. This is my number one most important tip for mean reversion. And when I struggled so often in these strategies and saw my boss doing so much better and getting different results from me, this was the only tweak I had to make to start turning that strategy around and becoming consistently profitable and scaling it higher. I've seen so many traders be negative and fail simply because they couldn't fix this common psychological mistake that all rookies make. I hope this helps you, and let me know your thoughts on this in the comments. Thank you for watching.
Okay, do you want to learn more actionable trading strategies like the one you just learned from Lance? Then watch the video, The Quickest Way to Profitable Trading, Easy Money Trades, appearing on your screen right now.